Thank you. So again, I'm Dave. I run the cyber practice at Brown & Brown. I didn't realize the screen was going to be quite this large, so I apologize for how big my face is here. But my background, so we are an insurance brokerage. I've been on the brokerage side for 9 years. Prior to that, I spent about 5 years on the underwriting side, underwriting these same sorts of products. So it's been about 14 years handling nothing but cyber and technology professional products. Just a quick rundown. I'll give you a couple 2 cents about Brown & Brown, and we can jump right into it. So I assume some of you have at least some background in cyber insurance products, so I'll give you sort of a short primer on what they generally cover. And there is some variance between markets. I can talk to that as well. But then we're going to spend the majority of the time on the market itself, claims trends, and coverage trends. So it gets a little bit deep. I know everybody's excited for the Thursday morning insurance policy language talk. So we'll do our best to affiliate here. And I will, just to kind of get myself a little out. So normally when I do these presentations, it's about 50% insurance market and 50% underwriting standards, because that has changed dramatically. We realized that heavily overlaps with the last presentation. So I've gone a little bit deeper on the coverage topics. This is actually the first one from this presentation. Hopefully it goes well. So real quick about us, we're about 2.6, 2.7 billion in revenue, 5th largest brokerage in the country, and we have a large presence here. Previously, I worked for Hayes Companies, which is a well-known name locally. We were acquired by Brown & Brown in late 2018. In January of this year, we took that name. So I would presume, just give our geography, most of you might know that name is not Brown. So to jump in to actual products, we'll start with a quick coverage overview. Talk briefly about forms, carrier participation. It's a very concentrated market. One really important thing here, use of third-party vendors and things we're touching on, and then pricing. Pricing is probably one of the most difficult topics here because it's so incredibly variable and specific to the individual applicant, right? We kind of give some guidelines of what to expect there. So in general, when we look at cyber insurance products, they're on a modular basis. So you see one form, but the deck page is going to have 10 or even 20 insurance agreements on it. I think about things in these sort of buckets. This isn't necessarily how they would be listed on the policy in this order, but I think of the first bucket in the top left there, your privacy coverages. So historically, this is what we think of with cyber products, right? Target, Home Depot, Anthem, Premier, those kind of events. You have an obligation to protect certain information. Something goes wrong, you have some liabilities to address. So within that bucket, the first one is your privacy and security liability. This is probably what most people think of in this area. So this is a situation where somebody sues you and says, I've suffered XYZ damages because you failed to protect my information, or you failed to protect your secure assets and that caused me harm in some other way. So that is covered, defense, damages, settlements, all that sort of thing. But it's not really the lion's share of what we see come in as claims under this insurance. The more common one is that second one down, the incident response costs. So not every single privacy event, security event, data breach is going to get you sued, but every single one is going to have some cost investigation and potentially public relations as well, depending on the profile. So within that area of the policy, that takes up about 65 cents of every dollar of claims. Again, this is within the privacy bucket of overall cyber policy. So that is the lion's share of those events. So that'd be, again, your legal, your forensics, DFIR, digital forensics, incident response. That would include if you actually do need to notify anybody, those letters that say, sorry, we lost your information. If you need to offer them credit or identity monitoring, and then if you have public relations, that all fall under incident response costs. These terms are not static across carriers. So some carriers might call that events management, some will call it cyber incident response costs. They'll vary a bit, but it's usually going to have that flavor to it. The next one down, your privacy regulatory defense penalties. So if you have a privacy or security issue, failure, event, then in some cases, a regulator with authority, most commonly it's going to be attorneys general, but it could also be HHS-OCR, there's various European legislators, et cetera, will have the right to come in and investigate and then potentially fine you, penalize you, force you into a settlement, make you contribute to the redress fund. So if any of those things were to happen, we would look to the privacy regulatory defense penalties. This is what it is. We're mentioning on this point that not all jurisdictions allow for the insurability of regulatory fines and penalties. So there are some state-by-state differences, and it can also depend on where that claim is actually brought. And then lastly, in this bucket is what we call reputational harm. That's a bit of a difficult thing to really wrap your head around, right? We all have an idea of what reputation is, but in insurance terms, we define reputational harm as a loss of net income. So you might be familiar with loss of net income in context of business interruption, right? My business is interrupted, I cannot transact business, and therefore I lost net income. In this context, reputational harm, you're still able to transact business, but your customers are going elsewhere, presumably because they don't trust you, right? I'm inclined to think that this coverage is most useful to companies that are more on the spot transaction end of the spectrum rather than companies that work on long-term contracts, because it's really easy to move your business on a spot transaction, right? If you don't like, shopping at Home Depot, it's easy to go to Lowe's, right? Whereas other things are harder to swap out. Below that, you get into operational coverages. This is really the name of the game in today's market. So this makes up, on the policy in total, this will make up about 80 cents of every dollar of loss. So in that operational bucket, the most common one that we see triggered is ransomware or extortion. But in a ransomware or extortion insurance agreement, this would be a situation where you realize you've been hit with ransomware. It's usually pretty apparent, unlike a privacy event that can be a little bit fuzzy in the beginning. But if we have a ransomware event or a one-off extortion event, it'll be pretty apparent to the user. And at that point, we bring in outside legal, outside forensics, investigate. Do we have an option to restore from backup? Do we need to pay the extortion? Are we legally able to pay the extortion? Right, there can be some issues with sanctions. So in that scenario, we would investigate all that, and then if necessary, we actually pay the extortion, right? So if that's what we need to do to get your business back up and running, we pay it, and we pay it out in this insurance agreement that's first under operation coverage. It's also worth noting that in most of these events, they don't want traditional cash, and when I say most, I mean all, they don't want traditional cash. They want some form of cryptocurrency. You'll see various types, right? Bitcoin's one everybody knows about, but there's a lot of other more obscure coins, and sometimes we have seen very, very obscure coins being used as the payment for extortion, presumably related to some sort of pump and dump scheme. But the cost of actually acquiring that is included in the insurance coverage because it's not expected that most companies are keeping large wallets of various cryptocurrencies that has its own set of issues. Almost every single ransomware or extortion event is then automatically going into a business interruption. So business interruption on a cyber policy is similar to business interruption on a property policy in that it covers the loss of net income and extra expense, right? Your increased cost of working. It's different in that it has a different trigger, right? So a property policy is going to cover physical events, wind, fire, ice, falling objects, whereas for cyber business interruption is going to cover malicious electronic events, right? Ransomware, could be proper hacking, malware services hacking, along those lines. So the business interruption usually makes up 80+% of a ransomware claim. I'll give you a live example. We recently had $300 million or so, $350 million retailer, online retailer. They had a ransomware event. Their extortion that they actually ended up paying, the initial demand was $1 million. We negotiated down to $550,000. The consulting fees were about $300. The total loss was $12.9 million, and the balance between those was almost entirely in the business interruption portion of coverage. We also had some hardware replacement costs, reconstitution of digital assets. So the vast majority of that $12.9 million actually came from business interruption. Right, it's really, really tough to transact business without computers nowadays. You'll also see a reference to system failure there. So system failure is simply insurance jargon for a business interruption event that doesn't occur because of a malicious act. Right, so operational or administrative errors, you apply a software patch, didn't go through proper testing, everything breaks, and you're interrupted in the same way. In insurance, we call that a system failure. Below that, you'll see dependent business interruption and system failure. So the same terms as before, but we've added the word dependent in front of it. So this would be for a situation where you are materially reliant on a third-party provider. Easy example of that, Amazon Web Service, Google Cloud, Microsoft Azure. And there's an infinite number of more niche software and service providers, and anything else that service providers that would fall over here. So when we look at this coverage, it's for the scenario where they get hit with ransomware or they get hit with non-service, so they have an operational or administrative issue that causes them to go down, and that outage causes you a loss of income. So it's covered in the exact same way, even though it didn't occur at you, the actual insured in the policy. And below that, we have two insurance agreements, which almost never happen in the absence of other portions of the claim. So restoration of digital assets and hardware replacement costs almost never happen without a ransomware event already being triggered. But in the situation of restoration of digital assets, it's frequently the case that when we decrypt or restore from backup, a small portion of your assets might not be used, right? Maybe we didn't have the best commercial form of decryption. Maybe there were some issues with the backups. So to the extent that we need to restore, replace, repurchase that data, we would look to restoration of digital assets. And then hardware replacement costs, we just colloquially call this a bricking coverage, right? There are certain situations where the malicious code actually gives firmware advice, makes it unusable, makes it useful as a brick, that's the clever name bricking. So the actual cost of replacing that hardware will fall here if it is financially better to replace rather than restore. There's a handful of other coverages that we see on cyber policies. Cyber policies are a relatively new insurance product, and insurance doesn't create that many new products that often. So it's ended up being to some degree a catch-all for a handful of other things as well. So multimedia liability, this one's really does feel like an outlier, but things like copyright or trademark infringement, defamation, libel, slander in the advertising of your goods and services, we would look to a multimedia policy for that sort of thing. Below that, your social engineering, so those fake CEO, fake CFO, fake vendor type scams, right? Hey, it's me, the CFO, we're buying a competitor, don't tell anybody because it's subject to SOX, but I need you to transfer money to this unknown bank account. We call that social engineering crime. And you can sometimes find that on cyber policies. The more appropriate area to get that coverage is on a crime policy. You can get larger limits there, or they're at least available on those policies. But sometimes you can get access to those through a cyber policy as well. Fraudulent instruction is sort of the other side of the social engineering coin. So social engineering is where you are tricked into parting with your funds. Fraudulent instruction is where somebody gains access to a legitimate inbox, then uses that legitimate inbox to trick a third party into parting with their funds, right? Typically in the form of a fake invoice. So that fraudulent instruction is something that is available on some, but not all cyber policies. And always, if it is available, it's on a very, very sub-limited basis. So you might have $1 million face value on the policy, but only say $100,000 available for instruction. It's very tough coverage to get. Professional liability, if you're a tech company, if you're some form of consultant, a number of other things, sometimes that would be available on a combined basis, particularly if those coverages are linked, especially in the tech companies. Funds transfer fraud, again, this is similar to social engineering, but where somebody actually introduces the code on their own or the instruction on their own. And then the last one that we touched on before, cryptojacking or utility fraud. So this is often part of the multi-pronged attack. In some situations, we will see malicious intrusion, and they will use your assets to mine cryptocurrency. Right? It's always better to leverage somebody else's assets to make money than use your own. So in these situations, they will use your CPUs and GPUs to mine cryptocurrency, which is mining cryptocurrency is just solving problems. And the impact of that is it drives up your electric bill. So that increases electric bill. So cyber is a little bit of an unusual market in that ISO form, Insurance Services Office, a standard product, does technically exist, but for all intents and purposes, nobody uses it. Frankly, it's just not really good. So every carrier with meaningful market share uses their own proprietary product, which makes my job really fun because they don't always align perfectly. So the coverage that you'll get from AXA XL will be generally similar, but we'll have a lot of differences from the coverage you get from AIG, from Visa, from Chubb, all the way down through Zurich. So we see a lot of difference in wordings there. You will see in some cases carriers offering endorsements on, say, a business owner's policy, right, a really small GO policy, on a D&O, professional policies, et cetera. There's nothing necessarily wrong with buying those. You should know what you're buying. So it's not simply a situation where you say, yes, I purchased this type of product, therefore I think it's good. You typically see very, very supplemented coverages, and again, this static solution at 10,000. And we know that the most common mode of ransomware payouts is more than 500, right? That part will generally concern me. So again, nothing wrong with buying that sort of coverage, but you do need to know what you're doing. When we look at the market in terms of carrier participation, there's allegedly north of 100 carriers that offer some form of cyber insurance product. However, 10 companies write 2/3 of the market. and the top 20 right north of 80% of the market. And you see when we get into 15 through 20, these market shares get into pretty rounding error territory. So at the top, you'll see your Chubb, your AXA, XL, AIG, Travelers, Beasley. They will sometimes swap in and out, which is number 1, 2, 3, 4, 5, but those are generally going to be your top 3, top 5 carriers. AXA XL is looking to reduce their book a bit. So I wouldn't be surprised if they dropped certainly out of the top 3, possibly out of the top 5 in the next 12 to 24, 36 months. But from there, you see pretty well name brand carriers playing through the rest of this. And again, this is top 20, so number 20 has a 0.9% market share. You get into some pretty small market share participants pretty quickly. One thing I do want to call out that I think is important is most insurance policies are going to have an obligation to use a pre-approved vendor for cover that for claims that would be covered under the policy. So again, if we have, whether it's a privacy event, whether it's a ransomware event, we're going to need some sort of outside help. That could be in the form of legal, it could be DFIR, again, individual forensic incident response, public relations, etc. But in all cases, these policies will have some sort of language that says you have an obligation to use somebody that we agree with. And in most cases, that carrier will put together a pre-approved panel, right? They'll say you can use law firms A, B, C, D, etc. You can use forensics firms A, B, C, D, etc. And I've included some of the language here. So most policies, this is really important to know for claim A, which is the whole goal of my work at least. If you look at, for example, AXA XL's policy, right? They'll cover reasonable and necessary costs charged by breach response providers. Breach response providers is capitalized and used the defined term. And those breach response providers are defined as the insurers, pre-approved panel of breach response vendors. So the implication of this is if you just call somebody you know that works in IT or somebody that works in a law firm, you shouldn't then reasonably expect that AXA XL is going to pay their invoices. Now, obviously, if we have that situation come up, we go to the carrier, we ask very nicely, we push them to retroactively approve, but it's not required by policy. Similar story with Beasley. So their breach response services will be provided by the providers listed in the information packet, and the information packet downstairs. Its definition is attached to the policy. Chubb is a little bit different, and I call this out because it's an outlier. So they have their incident response team. You can see this is from a policy that I actually placed. So their cyber incident response team will give you a full $10 million limit for that. It's got a $500,000 retention, except for the legal portion, which is subject to a sub retention of $100,000.
Excuse me, what does retention mean in that context?
Sorry for that. So for discussion purposes, retention deductible, same thing.
Oh,
Right. So retention would be your self-insured retention, the risk that you would take. Yeah. It's just for some reason, people in my area of the market decided we need our own special term for this. Yeah, special. But so we have that. So there, if we use a non-panel response provider, so they actually give you a pathway by which you can use somebody that they have not previously approved. However, they cut you in half, right? Now, you're probably not going to spend more than $5 million on that for a smaller, medium-sized company. This was for a particularly large company, and so they very well could go through more than $5 million. But there is essentially a penalty built into the policy if you use somebody that is not approved. Most carriers, certainly not all, but most, will agree to engage in a discussion if you have a strong preference, right? So if you come to them and say, I have a strong preference for this law firm and this forensics firm, most of them will be willing to say, okay, tell me about their qualifications, tell me about their rates, and as long as those things check out and are in line with what we expect, then we'll agree to endorse them on the policy on a one-off basis. But that is something that absolutely should be done prior to a claim occurring, because that negotiation is especially not fun in the midst of the claim when you're then delaying your investigation or delaying your counsel because we didn't have that discussion earlier. So pricing is one of the more difficult areas to estimate. It was only about 3 years ago that those of us in roles like mine were able to look at just about any applicant and yes, probably within 10% accuracy of the cost. That has gone completely out the window over the last 18 months. So pricing is, as mentioned there, heavily dependent on the carrier that you're working with, as well as their security posture. So underwriting, not to overlap with the prior presentation too much, but underwriting in the last 18 to 24 months has gone from very superficial. What's your revenue? What's your nature of operations? Tell me that you encrypt something, everything comes to that. to very, very, very granular, right? Asking about MFA for third-party remote access, asking about, well, you have a SOC, Security Operations Center, but is it 40 hours a week or is it 24/7? We get into a much higher degree of detail than we ever did before. So we see some.
Excuse me, Dave, and if you're gonna get, you can table this.
Yeah.
I'm a novice with respect to, if I'm a small company, do I need to be profitable? What are the minimum barriers to entry for carriers to want to insure me as a?
So if I think about small business and the most liberal underwriting standards of carriers that are willing to write small business, they don't care if you're profitable. They do want you to have revenue. If you're asking for limits that exceed your revenue, that can be a friction point. And then when we get to controls, they're going to want to see, standard compliance with applicable regulations. If you're subject to PCI, payment card industry standards, they want you to be compliant with it. If you're subject to HIPAA, they want you to be compliant with that. So that's very contextual. But in terms of nitty-gritty controls, we need to have bare minimum MFA for all remote email access, MFA for all privileged users, both remote and on-prem, MFA for access to backups. A lot of carriers in that space would not want to see liberal granting of local admin rights. So essentially the ability to add and delete programs to the computer. So some companies will say, well, I don't want to be calling a help desk every time I have to install a printer, so I'll just give them to everybody. Carriers don't like that. You need to see a rapid patching cadence. So do you apply critical and high report severity patches in under X number of days? If you're under 30, especially if you're under 14, you should be fine. And then lastly, encryption backups. So if you can tick all of those boxes, you should be reasonably attractive to the carrier that wants to write small business.
Is there a just general rule, like if the company only has 15 employees, but they wanted to get cyber insurance?
Yeah, that's not a problem. Some carriers don't want it. For example, AXA XL, if it's not 6 figures in premium, it's not their game. That's just not where they compete, but not every product is for everybody. There's plenty of companies that would still be happy to write an applicant with 15 employees. That's not the job. In the third bullet point there, some companies, particularly those that focus on small business, they might have premiums as low as say $1,000 or $2,500. One of the things to consider with those is that the carriers that tend to be the most competitive on small business might not offer you high limits. Maybe you can get 1 or 2, maybe 3 million from them, or they might not be acceptable to the market as a primary carrier. So if you were trying to build $30 million limit, you can't get that from a single carrier. You need to build what we call a tower. And other carriers might say, I don't know about that firm. I'm not going to sit excess of them. And therefore, you might need to pivot to a more expensive option. That's a different option, which will most likely be more expensive in order to get that participation above the tower. Most carriers will have minimum premiums, and this is for $1 million limit. Sorry if that wasn't clear. But most carriers will have minimum premiums between $5,000 and $10,000 per $1 million coverage, and then there will be additional tiers based on size, industry, exposure. And then this is one that we see, particularly in Twin Cities, we have a pretty healthy startup tech group here. But if you have a very unusual risk profile, so for example, if you are a healthcare technology firm and you have $1 million of revenue, but you have 5 million instances of protected healthcare information, that's a very odd risk profile. There's going to be a lot of carriers that simply say, that's not something that I have an appetite for. You'll see a lot less competition. Most people will just decline and say, that's not my game. And it's also worth mentioning, you'll probably be priced like other companies that have 5 million records, which then puts you into the ballpark of $1 to $5 billion healthcare systems for the most part. You might find an outlier. That's part of my job, is to find those outliers that don't price it that way, but that's something I typically prepare my clients for. So we've been in a hard market phase for ballpark 18 months. We really started to see this in mid-late 2020, but that was for exception of large companies, multi-billion revenue. We've seen this move its way down markets where we see it affecting essentially all carriers and all applicants. So a hard market is typically defined by five characteristics. First one, increasing premiums. Second one, increasing retention / deductibles and waiting periods. Waiting periods, if you're unfamiliar, so your business interruption coverage, loss of net income over a period of time. Instead of a dollar value retention of deductible, they'll often have a waiting period. So they say, look, if you have a 2-hour outage, that's something that should stay with you. It's the equivalent of a door date for an automobile policy. But if you have an outage that lasts for 96 hours, right, that's like a head-on collision for an auto policy, we insure that. Or your risk is transferred. Decreasing capacity, I'll get to that in a second. Coverage restrictions, which is where we'll focus quite a bit today, and then increased underwriting standards. Again, that's a lot of what I spend my time presenting on nowadays. Happy to talk about that, but it will not be a major focus on this presentation. So this is a graph of our actual price changes. So this is the premium that our clients paid between January 2021 and over here is March of 2022. So as you can see, it's been a little bit turbulent. We started off in January 2021 at about a 28.8% average increase. And that's not a rate increase. I do want to be clear about this. A lot of companies had less revenue because of COVID in 2020 than they had in the year prior. And this is usually based on prior year's revenue. So this is simply, if somebody was paying $1 in January of 2020, then that policy when it renewed in January of 2021 most likely cost $1.29. They're purely dollars out. So we saw a little bit of a ramp, then a much more aggressive ramp, and then we climbed Mount Everest, and we are on a bit of a backswing now. But what I want to be clear about is, while this looks good in the context of this graph, this is still about a 70% increase. And January, February, March occurred twice in this graph. So this means the people who got, say, a 30% increase in February of 2021, on average, again, averages, there's some issues with averages, this includes companies that have claims and a lot of other things. But on average, that company then got about a 70% increase in February of 2022. I can tell you from firsthand experience, not a lot of fun to deliver year-over-year material increases like this, but this is the market that we are in. There's a lot of different ways to slice this data. My team handles everything from pre-revenue startups all the way up to $40, $50 billion revenue companies. So this includes everybody. We can slice this different ways. These numbers would be sustained higher if we limited this to companies over $1 billion. It would actually be choppier if we were looking at companies under 50 million. So under 50 million is particularly turbulent. A lot of carriers will look at it and say, well, this was $3,000, I now need $6,000. Not huge money for a lot of companies, but it is 100% increase. So percentages, when you're talking about premiums under 10,000, can get really, really choppy.
So are you saying 30% increase in January and then 70% on top of the 30% increase? This is saying, okay.
Yeah. So none of us have a crystal ball, but we can make some hopefully educated guesses about how things are going. It does appear to many of us that we are approaching a plateau, right? So a plateau would just simply be at 0%, but 0% now would not be the lowest number, just means we're not seeing decreases anymore. So a lot of us think that hopefully, the earliest we could optimistically think that it would happen is Q4 of this year, that we start to reach a plateau where we are not seeing significant increases year over year on average. But there are things that could change that. So this gets a little bit ahead of myself, but the war between Russia and Ukraine, right? If we see significant electronic activity coming out of that, it happens to the market again. The next Log4j, the next SolarWinds, the next Cosmo, the next Microsoft Exchange, all of those have the potential to steal the market.
Does this reflect people who are increasing the self-insured portion of the policy as well, or retention?
So we actually, in many cases, yes, they are taking higher retentions. What I can tell you is that in almost all cases, at least in our experience, in almost all cases, when a firm accepts or takes a higher deductible or self-insured retention, it is because the market dictates that higher retention. It's very rarely the case that I actually recommend my clients take a higher retention because the discounts that we're seeing for it don't work. So this is opinion, not fact, but for me, I want to see at least 10% of the additional retained risk to even think it's a worthwhile discussion. So if I'm going to take my retention from say 50,000 to 100,000, I want to see $5,000 in savings, right? So if you pay more risk, 5,000 in savings. We're usually not even getting that 5,000. I think around 33%, so call it 15,000. Then it becomes a no-brainer because you're essentially betting that you have a loss less than once every 3 years, right? That's a good bet in my opinion. But we are almost never seeing discounts for higher retentions that make sense. Give you an idea of some of the claims trends that are causing carriers to behave this way. So this information is from Chubb, not to show any specific favoritism for Chubb, but they are the largest writer of this business, at least in North America. And they are more liberal with sharing the data, not with that. So since 2012, in Chubb's claims data, they have seen claims frequency, this does not measure severity, but claims frequency increased about 743%. And again, that's using 2012 as the 0 point, so we'll up there. And then we can overlay certain industries. So if we narrow this to financial institutions, we see about 242% more activity in financial institutions for the 2021 policy year. Insurance reporting is always a year in arrears because it takes time to put the information together. But for the 2021 policy year, we have about 2.5 times more claim activity than we did in 2012, roughly a decade prior. We look at retail and hospitality, and I know a lot of people won't think of those in the same breath, but at the end of the day, it's credit card swipes, so it makes sense from this perspective. We've seen a little over 1,000% increase in that same period of time for retail and hospitality risks. Professional services is pretty similar. So there's been a lot of activity in law firms. We've seen some activity in accounting firms, and this would be all forms of professional services. So just shy of 100% increase since 2012. Public entities are at about 1,700, 1,800% increase. They had a major spike in 2020, but you see that ramp up is increasing. When we get into these sort of percentages, you start to see carriers pulling out. So if anybody here represents a public entity, whether that's a municipality, tribe, water district, etc., those are incredibly difficult to place. There are more carriers than not who will say we simply don't write this nature of operations. And then manufacturing. I work in the upper Midwest. I have a lot of manufacturing clients. We see about a 4,100% increase in claims at manufacturers, again, measured against 2012. A lot of companies have gotten much more concerned with manufacturers. Now, manufacturers are more likely to buy this coverage, so the market has actually not behaved quite as punitively for manufacturers as it has for municipalities and public entities. But the standards for underwriting have gone through the roof, and I think that's been especially tough for manufacturers because they are not historically a highly regulated type of business. And we haven't seen them being subject to PCI. We haven't seen them being subject to HIPAA. We haven't seen them being subject to a lot of things. And a lot of them are very far behind. So you still see companies writing them, but we see more and more insurance companies saying, I'll write manufacturers, but my minimum premium is this, and it's high. Or I won't write a manufacturer over, say, 50, 100, 250, 500 billion, whatever revenue figure. So the appetite for manufacturers has gotten very particular. And these have become more significant. We've also seen decreases in capacity from carriers. So this is probably not something that most people think about often, but if I am an insurance company, I think about my capacity in 2 different ways. My capacity is how much limit can I give you as an individual buyer? How much market can I give to the group of buyers in total? So on a micro basis, almost all carriers are limited capacity for individual applicants. And so that's what we've got illustrated on the right here. So it used to be the case where I could pretty easily get a $10 million limit for any decent sized applicant. We found in recent times, most carriers are not willing to give any more than $5 million for any given applicant. And the simple explanation for that is they're not doing a great job of underwriting themselves away from ransomware losses. And the easiest way to not lose $10 million is to not bet $10 million in the first place. So if you only bet 5, you can only lose 5. It's been really fun for me because this instantly doubles my workload. I used to only need to talk about this is a real, obviously redacted client name, but this is a real situation for one of my clients. They were expiring, this was last July 31st. They were expiring at $544,072. They had a $50 million salary. I only needed to talk to 5 carriers to get there. They had a $500,000 retention for discussion purposes.
So they have 5 separate carriers that make up their total coverage.
Right, so I have a primary policy, an excess policy, and excess policy.
Got it.
Stack them on top of them and pull the tower. So we still had a tower for renewal, but I needed, actually technically more than 10 because this full disclosure had 4 participants in it. But on a renewal basis, we had 9 individual policies. We had, I believe, 12 participants. Our retention went from 500 to $1 million, and the premium went from 544 to $1,670,240.
Just for cyber.
This is just cyber. Yeah, this has nothing to do with D&O, property, professional. Yeah. And this this client was a, I'll just say they were a $1 to $5 billion healthcare provider. So that limited capacity has meant that we have more and more policies necessary to get the same limit. And then while this is painful, what's more painful is that more and more carriers on a macro basis are writing either net capacity or negative capacity, right? So if I'm an insurance company and I offer 10 $1 million limits in the market, I've deployed $10 million in capacity. A lot of companies said, well, I've deployed X dollars of capacity in 2020, and I either want to deploy the same amount or less in 2021. So what that means is carriers didn't have any new business growth goals. In some cases, they had the opposite. They wanted to make their book smaller. So you saw more carriers, more underwriters stepping back and saying, I'll wait and take the shots I really want to take. So that decrease in competition was immensely negative for buyers in 2020. Right? There's a technical rate need, but there's also the opportunistic fact that a lot of them knew they didn't have to compete anymore, and so yeah. So we do see in 2021 a nice little small trend. We have some carriers that are easing their capacity restrictions, and there are some, I'm not going to call them out specifically, but some of the top 5 players have re-entered growth mode, so that's the macro basis. And then on a micro basis, if they really like an account, right, it's an attractive class of business, it has good controls, et cetera, they will start to offer $10 million again, which I have some funds.
So the carriers reacted to news coverage from the state-sponsored actors like Bush threatening the marketplace. Or they just,
yeah, if you don't mind, I have an entire slide on that. It's a big talking point for us right now. I will get to that in just a couple minutes. So in terms of coverage changes that we see, probably the most frequent one that we have to deal with are ransomware restrictions, right? So your standard insurance policy is going to say you bought X dollars worth of limit, you therefore have X dollars available for a ransomware event. In situations where we have issues with the applicant's security posture, right? They're missing some instances of MFA, they have too much end-of-life software, they have a poor patching cadence, et cetera. We are seeing more and more carriers turn to ransomware supplements. What's most impactful about this is it doesn't just apply to the ransomware insuring agreement, which is the extortion payment itself. It applies to everything. So if you go back to that example that I used earlier of the company that paid $500,000 for their extortion payment, if we have a $250,000 supplement, for that company, it wouldn't be the end of the world. But if that $250,000 supplement also encapsulates the business interruption, which keep in mind the extortion plus the business interruption is $12.9 million, then this $250,000 is extremely painful, right? So if we end up with a ransomware supplement, you're in a very, very tough spot. Generally speaking, I don't like to tell my clients it's worthwhile to buy a policy with a ransomware supplement unless the carrier will give me a path to get that coverage back, and I'm reasonably certain that the applicant can do it. So, for example, this endorsement, which is from January 18, 2022, was for a client that got a ransomware supplement simply because they lacked MFA for third-party remote access. So I talked to the client, they said we can get that implemented in 2 or 3 weeks. And we agreed that, okay, that's a risk worth taking because the price on this policy was actually pretty favorable in comparison to the rest of the market. So we were willing to do it there. But in other situations, and especially if the applicant, my client, isn't reasonably able to get those things implemented in a short period of time, this is a lot more painful. And again, we don't see almost any companies applying this across the board. So it's very rare that you see an insurance company say, I'm going to do this on every policy. This is almost 100% of the time specific to responses on the application. This is something that we see only from a handful of carriers right now, but some of the carriers that are doing it have very, very large market share. And I think it's reasonable to assume that they might be able to influence the market, or that other carriers might feel emboldened to follow suit because big name brands have done it. But so we have a couple carriers that are looking to limit coverage for what we call widespread events. So the widespread event would be any event where one thing can then trigger tens or hundreds or thousands or tens of thousands of policies, right? It is a systemic threat to the market. And some examples of that would be solar winds, Kaseya, Exchange, Log4j. These are all things that happened within roughly the last 18 months. And so we do see some carriers looking to supplement widespread severe known vulnerability exploits in Log4j. Widespread software supply chain exploit, that would be positive Exchange. Widespread zero-day exploit, which is not listed here, but 0 days. Essentially, it is a software flaw for which no patch exists. And then all other widespread events which captures anything that we previously described. So in this situation, this carrier, for sizable business, will give you the full policy limits, and they will not apply any co-insurance. So co-insurance in this context is not like on a property policy where you have to insure that 80% of the building's value to get replacement costs. This is co-participation. So you have $1 of loss, you're on the hook for 50 cents, the insurance company pays 50 cents. So your self-retaining risk becomes that much higher, right? It's a proportion of every dollar. So again, this carrier is not, they're introducing the mechanism, but without any teeth on larger policies. They're introducing the mechanism with teeth on smaller policies. And we can reasonably assume that maybe 12 months from now, the larger policies will have with teeth. CVEs are critical vulnerabilities exposures. So a situation again where we have a known software vulnerability, and in this case, a patch does exist for it. So there's some friction in the market because we have a whole bunch of applications that say we apply software patches in a very short period of time. And then we have a whole bunch of claims for software patches that want to apply for a long period of time. So carriers are understandably frustrated with this fact. So we see some carriers that are starting to put sliding scales in there that essentially say, put your money where your mouth is. So this is an example from Shutdown. They will essentially say, if you have something that is unpatched for 0 to 45 days, we will cover 100%, 100 cents on the dollar, right? You don't have the code participation. If it's unpatched for 46 to 90 days, we'll cover 95 cents on the dollar, still offer. Then we start getting into some more severe numbers. 91 to 180 days, 10% is your risk. 181 to 365, they'll pay 75 cents to the dollar, and retain the risk of 25 cents per dollar. And if it's been unpatched for longer than a year, they'll cover 50 cents of every dollar of the loss of retention. So it's similar to protective safeguard exclusion or some protective safeguard requirements that you might see on a property policy. It's somewhat common for a property policy to say, well, you told us that you have sprinklers in your building. The sprinklers better be there and better be operational when a claim happens, or I'm not going to complain. So they're sort of mimicking that idea and applying it to cyber policies. More restrictions. So this is if anybody's familiar with RIMS, which is funny enough, it's actually the second largest convention in America. I found that out recently. But it's basically when a whole bunch of insurance people go to one city and talk about insurance. This was a huge talking point of RIMS, which was 2 or 3 weeks ago. So a little bit of a primer. In 2017, Russia, who had already had boots and tanks on the ground, either in Ukraine or at Ukraine's borders, attacked Ukraine with something that looked like ransomware, but it was actually a wiper, meaning that it said, we've locked up your data, you can pay us to get it back. Just kidding, we deleted it already and you can't get it back. That was later named NotPetya. So NotPetya is essentially a 4-letter word to people that work on these products. So that's important to know. We'll come back to that. So historically, cyber products have included what we call carve back to the war exclusion. So the war exclusion would say we don't cover war, warlike actions, hostilities, violent insurrection, etc. However, we will cover electronic events, right, which then gives you essentially a full pathway back to cyber war, electronic war, whatever you call it. It sounds very cheesy to say it. But if you've seen the news in the past couple of months, there's reason to question how we approach this, at least from the carriers. So a few months ago, the Lloyd's Market Association, LMA, issued 4 template versions of more restrictive war exclusions. And those vary in how favorable they are for the insurer or the insured, policyholder. But in either case, they're worse than the old versions. So we've been in several situations in the past few months, particularly with some of our larger clients who are more reliably Lloyd's buyers, where we say you can have your Lloyd's policy with an uglier war exclusion on it, or you can buy this domestic option that has a more favorable war exclusion, however, it's more expensive, and we have those choices to make. We've been asking our domestic trade partners if they plan to do anything about this. So far, the feedback has been, no, we're not doing anything about it right now. However, we are paying close attention. So we'll see how the future goes. What's interesting coming out of RIMS a few weeks ago is that there are rumors that reinsurers, so insurance companies also buy insurance. They don't retain all of that X dollars of risk that they tell you will cover. They buy insurance to cover those risks as well. And reinsurance is the tail that wags the dog very frequently. So there are rumors that 2 of the 4 reinsurers that make up something like 70% of the cyber reinsurance market want to force more restrictive war exclusion language precedent to 2022 reinsurance treaty renewals. So exactly what that looks like is to be determined. There's a lot of sticking points with some of those wordings, right? If you take an example like Stuxnet, which if anybody's not familiar, that was for a long time it was known but not verified that it was a joint U.S.-Israeli attack on Iranian nuclear facilities. It was the better part of 10 years before we got genuine attribution. I can't imagine that a carrier wants to keep that claim open for 10 years. Sometime over the course of a decade, they're going to pay the claim. And then if attribution is made 10 years later, I can't imagine them going back to claw back that money. So it raises more questions than it answers, but it is a topic that is being fleshed out.
Has the government administration looked at supporting the reinsurer market with this war? Russia? Or
Yeah, there's been some rumblings about a cyber trio. I'm not holding my breath personally. Yeah, not to get into political comments, but I don't think it's got a great chance to get through. I wouldn't be unhappy to say that, particularly if it was specific to state-sponsored or state-acknowledged actors, because in a lot of these situations, it might not actually be the FSB or GRU that's conducting it, but if Russia is perfectly aware and effectively consenting to what's going on in their country to attack U.S. companies, that's an important detail, even if it's not truly state-sponsored. So I would welcome a cyber equivalent of TRIA, especially if it then opened up other systemic risk coverage for my clients. But I can't say I have a ton of optimism about it being passed in the future. A couple other topics to touch on. So we do see some carriers that for systemic risk reasons want to see governmental shutdown restrictions or exclusions. So systemic risk is something that a lot of carriers are very, very sensitive to right now, because to be very plain about it, if every single policy is triggered, there's not enough money to pay. Right? They're instantly bankrupt. So we do see some carriers looking to add wording that essentially says if a claim arises out of a government mandated shutdown, right? So somebody attacks AWS, the government marches to AWS and says turn it off. That's not a business interruption claim for you. However, there's a part back, at least in this example of this wording, that says if it's solely against the insurance computer system, so you are the sole target of that attack, then coverage would still apply. This isn't one we've seen gain a lot of traction in the market, and to some degree I would be surprised if it does gain traction. This is junk language. Again, they are a little more, let's just say, sensitive once it's said. And then I believe this is the last one in the presentation, but end-of-life software. So end-of-life software is software that is no longer supported from a security standpoint, patching standpoint by the original manufacturer. So from a cyber underwriter's perspective, I would imagine that they view end-of-life software the same way a property underwriter views a condemnable. Shouldn't be there and shouldn't be used. However, we still do have a lot of examples of it. This is something that is a really growing trend in underwriting, and we're seeing more and more carriers look to exclude this type of exposure. So this is from a carrier that has very, very strong language on it. Essentially says if you have unsupported or legacy computer systems, you don't have to cover claims based upon the rising out of vulnerability or exploitation if the manufacturer has withdrawn or no longer supports the system, or, and this one is, I've been fighting with this language, patch or update has been issued and made available to you for such vulnerability, but it has not been applied. Now, if you're in a situation where it's patch Tuesday and you haven't applied it by Thursday because of your internal testing, that's my argument to them. I'm like, this part B is unreasonable, right? So if it was a table like what we talked about earlier, I might be a little bit more sympathetic to it. But back to the point, end of life software is a major sticking point for carriers, and we do see more and more carriers that are looking to flatly exclude claims involving end of life software, not just where it's a point of compromise or where it's involved in the claim at all. Or this can sometimes trigger ransomware supplements, and then we're back about 5 slides ago, and we're talking about that. End of life software is usually difficult to get rid of, right? It's not MFA that's easy, you just implement it and then you're good to go. This one is usually a little bit more foundational to the company. It can take a long time and sometimes a lot of to the meeting.